welcome to UBP TV. This month's summary of our asset allocation will focus in turn on bonds, then hedge funds, gold, currencies, and we'll finish with equity markets. On bond markets, we've seen over the last 8 weeks a marked rise in interest rates and also a marked widening in credit spreads. This has been driven by the Federal Reserve's communication, letting the market know that their asset purchases would begin to be tapered by the end of this year. Our recommendation to investors remains the same. Keep duration extremely low so as to be protected against this rise in interest rates. Within fixed income, our preferences are short duration high yield, where the pickup in coupon compensates for higher interest rates, and non-directional fixed income strategies. These are go-anywhere strategies, flexible in terms of their credit exposure, flexible in terms of duration, and which do not adhere to any particular benchmark. Secondly, let's talk about hedge funds. We've noticed over the last 6 months a decrease in correlations in the market. That is, the market is in less of a risk-on, risk-off mode and placing more importance on fundamental factors driving stocks, sectors, or individual markets. This, combined with an increase in the levels of volatility, we think makes a very attractive environment for hedge funds. Their opportunity set is much better today than it has been. And within hedge funds, our 2 preferences are discretionary global macro managers and long-short equity traders. Now, gold. As we've seen, there has been a normalization in markets. A gradual healing process is underway. And investors have begun to place less importance on safe haven assets such as gold. At the same time, we've seen liquidation of portfolios, in particular of ETFs, which have put downward pressure on the gold price. The medium-term outlook, we think, remains very strong. We like the fundamentals of the gold market, with continued demand from central banks, in particular in the emerging world, continued demand from buyers of physical gold, in particular in China, and also with the forthcoming decline in production from gold mines, which will be linked to the fall-off in exploration success that we've seen over the last decade or so. This creates a very favorable demand-supply imbalance in favor of gold for the medium term, but in the short term, we think that the gold price is likely to remain under pressure, and so we've reduced our allocation to gold tactically in portfolios. Now on to currencies. Here, our preferred currency is the dollar. The dollar is benefiting from the strong fundamentals of the US economy and also from the speculation about the tapering of the Federal Reserve's asset purchases. The dollar will strengthen against emerging currencies. In particular, we think against those emerging currencies which have declining current account surpluses or indeed current account deficits. The dollar will also strengthen against the euro, against the pound sterling, and we think will continue to strengthen against the yen, which we view as the weakest of the major currencies. To conclude, on equity markets. Equities have been and remain our preferred asset class for this year. Last month in June, we decided not to increase equities because we felt there would be a better opportunity coming. We got that opportunity at the start of July and have increased our allocation to equities. In that area, we're focusing on European equities, where at less than 12 times current year earnings, we think they're extremely cheap and under-owned in the institutional portfolios. In terms of sector allocation, we like consumer staples, consumer discretionary stocks. In defensives, we like telecoms and healthcare, and we're also overweight in industrials. We continue to like Japanese equities, and our focus, you'll have gathered, is on developed equities rather than emerging market equities for the remainder of this year. So to conclude, we continue to be defensive on bonds and recommend low duration. We continue to like hedge funds, in particular flexible trading strategies. We continue to recommend that the dollar be overweighted in portfolios relative to all other currencies. And we continue to think that equities will be the strongest performer for 2013. Thank you.